Welcome to Frank Wealth Insights, a financial and investment podcast from Return on Life Wealth Partners. They look at your money. We look at your life at returnonlifewealth.com.
Good morning, everyone. Let's look at your life. I'm Frank Fantozzi, and I'm the president and founder of Return on Life Wealth Partners. It's exciting and hard to believe, but we're celebrating our 30th anniversary of helping people achieve a life well lived. Couldn't be prouder of my team and all the accomplishments we've had in regards to helping people create clarity in their financial planning world. I'm really excited today because I'm joined by our special guest, Danielle, LeChard, a teammate and excellent wealth advisor, and we're going to be talking about life insurance and how that fits into your overall financial plan.
Frank, I am excited to join you. Let's get into it.
All right, you start.
Okay, so, what is life insurance and what type of life insurance generally would a person need?
Well, I'm going to start first with, if you do need life insurance, really your first determinant is figuring out how much coverage you need. But really, life insurance, when you think about insurance in general, you are taking the risk of an unfortunate event and transferring it to an insurance company. So when you think about what an insurance company does, whether it's disability insurance, property casualty insurance, they are pooling all of their members or clients together, and their money is pooled. And then based on statistics and analysts, the actuaries that they hire, they figure out, what is the amount of money we need to charge for that type of insurance coverage so that they can make payments in the event of a fortunate accident. So when it comes to life insurance, the risk of death, mortality, what is the financial consequence of that event? If you were to pass away, depending on what stage of life you are in, what amount of coverage would you need to keep the financial bedrock of your family or your life in check? Because everyone has a financial footprint, and once you remove that person from the equation, is there a deficit? Is there a risk to people that depend on the person that's passed away? So normally what we do is with clients is when we do a financial plan, and when you look at the foundation, you're looking at estate planning, building emergency reserves. Can we start building an investment portfolio to grow for future needs like retirement? Another foundational block is your protection planning, and one of those facets that fall under the umbrella of protection planning is life insurance. So the first thing people need to think about is, again, if something were to happen to me, would there be a financial consequence to people that depend on me? If there's really no financial consequence to anyone, then there's really no need to have life insurance. However, let's just take a simple example. You have a married couple with 2 children. If either spouse were to pass away, what type of things would you need to worry about? Is there a mortgage on the house? Is there educational funding for the children? Most of the time today, you have both parents, both spouses are working, so now you have to worry about providing care for the children. So the list goes on. So for your basic needs, if a spouse were to pass away, there would be a financial consequence. So the first thing we look at is really determining, 1, do you need life insurance? And then 2, figuring out how much insurance do you need. And again, the easiest method we like to look at is, what are the financial obligations, the financial footprint if we remove that person from in this case, the family. How do we calculate the amount of insurance we would need so that the family could continue to achieve the goals that they have?
Great. Okay, so, with that being said, so are there different types of life insurance? And can we talk about, how you actually pay for life insurance?
Okay, yeah. Life insurance, unfortunately, is probably one of the more complex financial vehicles out there, in the sense that there are a lot of components, especially when you get to what we call cash-based type life insurance policies, or people refer to them as permanent life insurance policies. You'll hear whole life, universal life, variable universal life, and then there's derivations from those policies. So it can get quite confusing, and it's probably beyond the scope of our podcast today to get into all the mechanics. I would just, for our audience sake, say these are cash-based policies and they're permanent. And the reason why they're called permanent is they're meant to be in place for your entire life.
Okay.
All right. Now, Danielle, you and I don't have a crystal ball. We unfortunately don't know when the last day of our demise will be. Mm-hmm. So we look at these as permanent coverages because in the event that you pass away at some point way in the future, the insurance is in place. The other type of insurance is what they call annual renewable term, or what they call level term, but it's term insurance. And again, term means there's a term certain that you're going to insure for a certain period of time.
So if I were to buy term insurance and, you'd say, let's say I buy it up to age 60, that would be a possibility and it would cover me throughout that whole period of time?
Yes, there's 10, 15, 20, 25, 30-year term policies that can be bought. Now, not every insurance company has all those term limits, so you'd have to shop for those coverages. But the thing I need to teach people is there's this huge debate. Well, term insurance is very, very cheap. That's why I'm going to buy term insurance. I don't want to consider permanent at all. And there's the argument, I'm going to buy term and invest the difference and my investments will grow and that'll be better than buying permanent insurance. And basically, I think if you do need permanent coverage, and we'll talk about reasons why you might need permanent coverage, usually buying term and investing the difference is not really a good approach, especially if you do need permanent coverage for some reason. Okay. But you need to think about mortality, all right? Would you agree, Danielle, that as we get older, the chance of us passing away from accident, illness, unfortunate events increases?
Yeah, true.
Yeah, right. So if you can imagine, and this is probably the difficult part because we're doing this on a podcast, but if you can imagine a hockey stick, the shape of a hockey stick.
Yes.
All right. As the hockey stick starts to swoosh up, right, it accelerates. So think about it. As you get older, the chance of you passing away increases. And as it increases, the cost of insurance, you would think, would correspondingly increase. So if you look at term insurance in its base form, annual renewable term insurance, every year you get older, the cost or unit of insurance will increase. Right? Now, people have a tough time budgeting, and then they also don't like the uncertainty of, well, wait a minute, what's the insurance cost going to be next year, the year after? So what's become more popular is to buy what they call level term. And basically what you are doing as a consumer is you're prepaying. In other words, you're overpaying in the early years, and the insurance company has your money, and they're investing it in their general account to offset the increased costs that you would pay in the later years. So if you look at 20-year term insurance, for example, the first year of that 20-year term policy is much cheaper than the 20th year, but the insurance company levelizes it. So now you as a consumer can say, listen, I can budget. I know it's going to cost me $1,000 a year for my $500,000 coverage, right? And those are just made up numbers, so don't quote me on that. So what we find is, and the way I would say for most people is, if you can think of a bell curve, there's that sweet spot of time where I'm still using the focus of a 4-person family, parents, 2 kids, right?
Okay. You
usually have this high need. You have a mortgage on your house. You have to provide money to a surviving spouse to fulfill retirement goals, fulfill educational goals, things like that. So you do have this high need. And term insurance is really perfectly set for that. So depending on how long that period is, whether it's 10, 15, 20, 25 years, you could find an amount that would meet your need.
Okay.
Now, some people feel that there is a need for permanent coverage. I need something for my entire life. Now, what are the reasons for that? One, I still think I need to provide coverage to my family in a smaller increment where there is some, upon my death, there is some money, whether you consider burial insurance, whether it is I want to make sure my spouse is taken care of, to possibly leaving a legacy to the kids. Some people say, I don't want to be worried about cutting back on my retirement just so I can leave my children some assets. So what I'll do is I can spend like a drunken sailor, as they said, but I know my life insurance will be there so that when I pass, I can leave that to my children. So the suffice it to say, the issue is I know I need money for my entire life at the consequence of my death. Since I don't know that, that timing, obviously, permanent coverage is better suited. And then there's advanced cases beyond the scope of our podcast where you can get into estate planning. People that are very wealthy have an estate liability, and sometimes legal remedy can't help. And so life insurance is a way of passing on more wealth to the family because the government's going to come in and take 40% of everything that you have. Some people also use it for charitable giving. Upon my death, I want to leave a legacy to my alma mater. So those are possible needs for permanent coverage, and then determining the right vehicle, whether it's whole life, variable, universal life. Those will have to be done in the meeting to say, okay, which is going to best meet my needs.
Okay, so it's kind of like a forced saving vehicle. So can you kind of give me an idea on how it's possible to customize these policies?
Yeah, so one, the various types of life insurance policies, in regards to premium, that's one way.
Okay.
So, for example, variable universal life contracts utilize investment vehicles inside of the policy. So there's a possibility of earning more rates of return. So I can customize saying, well, listen, I'm a believer in the stock market. If I can generate 6.5%, my premium will be based on the fact that I'm generating 6.5%. So my premium could be lower than a whole life policy. Now, a whole life policy is a less riskier permanent coverage. Why? Because there are much more guarantees in the policy. The insurance company is really managing the cash value. But for that guarantee, I'll equate it to like a CD, right? You go to a CD guarantees you a certain amount of money, but it never really compares or can beat market performance normally.
Okay.
Right? You might get that one odd year when cash is king and the markets don't do well, but overall CDs aren't really a long-term savings vehicle in our opinion. So if one way you can customize is based on the type of financial vehicle you use, you can work on your premium.
Okay.
The other is through various waivers or riders. For example, you could do a waiver of a premium rider that if I become disabled, the insurance company will continue my coverage. I could do an acceleration of death benefit rider where if I meet certain requirements on the policy and I'm terminally ill, they will pay some of those benefits in advance. I could do a long-term care rider. So there's a number of riders that could be used. Now again, riders aren't free. There's no free lunches here.
Of course.
Right. So these riders can deal with some of the peculiar requests or risks that the applicant, the insured, wants to make sure that in any of these events, these riders will help protect them.
So these are, riders are to be purchased depending on your expected needs in the future, right?
That's exactly right.
Okay.
So your advisor should be sitting down with you and saying, again, we talked about the waiver of premium. Say you don't have good disability coverage, you can't get good disability coverage. Group coverages are usually limited, and life insurance is very important to you. And if you, for some reason, cannot work because of a disability, the last thing you want is your insurance to go away. Because remember, we talked about that being a foundational benefit. So a waiver disability rider is possible. I will tell you one that's really important, and what I really want to emphasize is on term insurance. So sometimes there's a rider for convertibility.
Okay.
And I'll talk about what that is in a second. Sometimes it's actually built into the policy. So convertibility is this. Think about it. Normally when you're younger, you're healthy, right?
Yes.
You don't have any issues. You get this really nice premium because, premium's based on and we'll talk about underwriting in a little bit, but, if you're really good and healthy, your premium's much lower because you're less risky to the insurance company. So now you buy a 30-year term policy. And right in the beginning, you don't think I need permanent coverage. Again, it's really hard for individuals to think, what's my life going to be in 30 years?
Yep.
But to protect yourself, to say, I want an option that if for some reason I become uninsurable, I still need insurance, maybe permanent insurance, I have the right to convert my policy up to the limit that I take out. So if I took out a $500,000 30-year level term policy, I can convert all of that or some of that up to $500,000 to some form of permanent coverage that's allowable under the agreement.
Okay.
Here's the thing. The benefit here is this. 30 years from now, like you're healthy as can be, right? 30 years from now, you become diabetic, you have other issues, and you say, I need permanent coverage. The insurance cannot deny you converting to a permanent policy. They can't they can't rate your premium based on the fact that now you're diabetic, which would increase your premium. Okay. They have to use the original underwriting. So if you are standard plus, that's one of the options, you can come out from underwriting. Standard plus, they would convert you as a standard plus 30 years from now, even though based on your health, you could actually be denied.
Wow, it's a huge benefit.
It is. And then, the only thing you have to do is, you have to pay the premium based on your age and your health rating based on the initial underwriting, 30 years ago.
Wow, okay.
So term insurance, I'm a big believer of putting a convertibility option, because a tenet in our planning in our firm is we want our clients to have options and control over their fate. Mm-hmm. And so the convertibility rider maybe adds 5% cost on a term policy. It's, to me, in my opinion, professionally, it's well worth having a convertibility option. So you have to make sure it's on there, and you have to ask, because some advisors or people that are recommending insurance forget to talk about that, and everyone's premium focused. I want the cheapest. Well, yes, but you get what you pay for. And if you don't understand what you're buying, you can miss an opportunity to protect yourself 30 years from now in this case.
Yep. Forward thinking.
Yep.
So, can we talk about, what would happen if somebody were to, buy a policy and then miss a payment somewhere down the line?
Well, insurance companies are really good about sending you notices in the mail or an email, depending on how you set up your communication with the company, that, hey, you missed the payment.
Okay.
And sometimes it's inadvertent. You go on a family vacation, you're trying to get all the stuff done, you miss a payment. They normally give you 30 days grace period. So that grace period allows you to make up the payment and handle that. It's probably more critical on term insurance policies because there's no cash value. With a lot of cash-based policies, typically what happens is that the policy will take a loan against itself because you have cash value. Oh. And then you can either repay the loan or not. But the first thing you always will receive from the insurance company is a nice notice saying, hey, you may have forgotten to make your payment. You have 30 days to reinstitute it. If not, and especially on a cash-based policy, they'll usually spell out the options that'll happen if you don't make the payment. Okay. With term insurance, however, there's no cash value, so you either pay it or you potentially forfeit the policy, especially if you let it get out of grace period.
Okay, good to know. So do not miss a payment.
Yep.
So you mentioned before underwriting in the process of obtaining insurance. Can we talk a little bit more about what the underwriting process looks like and the application process?
Sure. So here's the thing. The insurance company knows zero about you.
Okay.
Right? And, let's just use, $1 million of coverage. And you go to them and say, listen, Mr. or Mrs. Insurance Company, I want $1 million of coverage from you. Well, I need to know a little bit about you. And we mentioned earlier about actuaries and things like that. So believe it or not, there's a lot of information that really is pretty accurate about, given your medical conditions, what is the probability of you, and let's make it easy, out of 100 people, what's the probability of you, if you are diabetic or overweight or have a heart condition, or you're perfectly normal and healthy, you're the iron horse, you could go on forever. They have a pretty good statistical database of, wait a minute, this person has a probability of dying by this percent at this year, and so on and so forth. Okay. So your premium, their offer to you, is based on your health underwriting. So what happens is you're going to get this nice long application, whether it's, a lot of them do it online now, or you can do it the old-fashioned way with paper, and they're asked all about you. Okay. They're going to ask about your doctors, and usually they go back about 10 years. They usually will say, did any of these events happen? Do you have high blood pressure? Have you had a heart attack? Have you had a stroke? They'll ask about members of your family, your siblings, and your parents, because obviously things could be genetic and hereditary. Yep. So they're going to get all this information on you, and you're going to submit it. Now, a little common thing we talk to clients about, and it's not required, is if you send in your application with 2 months premium, you can actually bind the insurance company as long as you don't lie on the application. Because remember now, you haven't been underwritten, but they will let you bind the insurance company for coverage if you submit premium versus waiting till the insurance policy is issued.
Wow. Okay.
So you're going to go through this underwriting process. So say you send the application in. I would tell you it could take anywhere from 45 to 90 days. And the reason why I say that conservatively is they have to get your medical records, right? And depending on how fast your doctors are good about sending your medical records in, then their underwriting team, which has medical specialists besides actuaries, they're going to look at your data and they're going to say, we think this person is the healthiest person we can. And they're going to give you like a super plus rating, which means your cost per insurance per thousand actually goes down.
Interesting.
Now, normally when we meet with clients and we ask, do you have any health issues? If they tell us, hey, we're normal, there's no issues or things like that, we will run the illustration. The illustration is something that the advisor will say, hey, this is the kind of coverage we think is appropriate for you, and this is what it's going to cost. So they run what they call an illustration. It's a projection. We recommend running it always at standard, which is what I call average health rating.
Okay.
Now, say it has a premium of, we used the word earlier, $1,000 a year for term insurance. If you are healthier than a standard person, your premium might go down to $850 a year.
Great.
Yeah, good thing. However, if something shows up on your underwriting, your medical history, and you didn't divulge it to me, they could say, well, you know what, Danielle's not average, so we're going to rate her, a +1, which means that her premium, instead of being $1,000, might be $1,100.
Oh, okay.
So there's a whole range of offers that you can receive, and that's the important thing. You're going to receive an offer, and I'll talk about that in a second. But you're going to receive an offer from the insurance company, and then based on that offer, you have the right to accept it or reject it. So sometimes it makes sense to maybe shop, apply to more than one company. That's a possibility, especially when the premiums are big. Like when you're looking at large permanent policies, and it's very large numbers we're talking about, underwriting with 2 or 3 companies. Now, the insurance companies share a database, which people don't know. And that database, they know how much coverage you potentially have in force. They know how many times you've applied to different companies. So it's hard to be really sneaky and try to pull one over on the insurance company.
They can all see everything on the background.
Yeah, there's a national database. The other thing to keep in mind, they are trusting that you're going to answer these questions correctly. And I'm going to share a story about someone who lied to me in the underwriting and actually passed away on the coverage. So what happens is they're making an offer based on the truth. And if you lie, and you lied because you knew if the insurance company knows they were going to charge you more money in the form of a higher premium.
Got it.
So my client at the time, they ask you, do you use tobacco? Now, I don't know if you use tobacco. I might know you well as a client, but unless you smoke in front of me, I don't know.
You don't know.
Right. So this person, they asked if they use tobacco. They told me no. Now, after the fact, we found out because when he died in a water accident, and it was within what they call the contestability period, which is 2 to 3 years, depending on the insurance company, they have a right to, quote, deny the claim.
Wow.
So when you file the claim. So they found out on the medical records that he smoked tobacco. He had a cigar room in his house. And even though I knew him professionally, I did not know, he never smoked in front of me, and I never knew, he never raised the fact that he smoked cigars. Because you as an advisor, if you know anything and you allow the client to lie, you could be in trouble as a professional. Right? So what happened is initially they wanted to deny my client the claim. And I said, well, that's not right. You have to go back and adjust the underwriting as if he told you he smoked, what would his offer would have been. And in this case, they went back and said, well, hey, we would have given him a smoker rating. So instead of getting, I'm making the numbers up, $1 million of coverage based on the premium he paid, he's only going to get $600,000 based on the premium he paid, because that's all he could have bought based on the premium he paid in today. The only thing that would probably get you denied is if whatever your condition is that you lied about would have made you uninsurable, then the insurance company could come back and deny the claim, saying, listen, if we would have known this about you, Danielle, we would have never, ever, written it up. So, for example, one of the things on the application is if you're into crazy sports, like skydiving, motocross racing, auto racing, because they ask you, do you participate in any hazardous recreational activities. And doesn't mean you can't get insurance. It's just you're going to pay more for it, or they can exclude it based on the type of activity. Like scuba diving is a hazardous activity. And so if you lie about that and they find out that you were a Formula One racer and you die in an auto accident on the track, they could have denied that.
Okay.
So it's really, in my opinion, professionally, it does not make sense to take the risk of lying on your application just because you want to save a few dollars on the premium. Because what ends up happening is your family's obviously counting on this insurance benefit, and you don't want to put it at risk because you lied on the application.
Okay. So I guess I have a question then. So what about for, if somebody in the past has had cancer or open heart surgery, would those people be considered insurable?
It depends. So as I shared with you, they ask about those questions on the application. Normally, insurance companies look back about 10 years.
Okay.
There's a whole slew of medical issues out there, so I can't, in a podcast, comment on every one. But if you have a cancer that has a high cure rate, or for women, breast cancer, okay? If you've gone 5 to 10 years, and I would say with cancer, probably 10 years without an incident, without a relapse, you can get insurance. Now, you're not going to be, you could be healthy in every other respect. You're probably not going to get a super A+ rating, but you could get a rating that doesn't make your premium so obnoxious that you can't afford it.
Okay.
So normally, they look back 10 years, and with cancer, for example, they want to know, based on regular follow-up, have you been clean for 10 years? So they'll ask you to reapply. So it depends on the medical condition. I will say, like chronic medical conditions, like Crohn's disease and all that, there's no cure for that. Anything that's chronic is going to be reflected in the premium. So that's what they're looking for, is what health issue is going to increase your mortality rate. So anything that increases your mortality rate, based on logic here, will either increase your premium based on your health rating, or to a point where it's too much risk for the insurance company, and they're going to say, listen, we're not going to underwrite you. You're just too risky to underwrite.
Okay. So would you say that there's any other exclusions or limitations to life insurance then?
Well, the big one is, the other one is suicide.
Okay.
So there's, depending on the insurance company, a 2 or 3 year look back period, that if you commit suicide, because you can imagine someone distraught, I'm not going to leave my family in a lurch, so I'll go out and buy some life insurance. And I'm normally healthy, and I haven't, there's no medical records of me seeing a psychiatrist or a psychologist. There's none of that in my symptoms. I haven't been prescribed medication for my mental disorder. So there's nothing like that, and I'm just depressed. I'm going to buy some life insurance, and then God forbid, I unfortunately kill myself. If it happens within the contestability period, that's one where the insurance company could come in and say, we're not going to pay. Other ones would be like active war. If you get drafted and you have to go to war, the insurance company is, those are specific exclusions in the contract. Active war, they're not going to pay if you get drafted and have to fight.
Okay.
So.
Well, thanks for explaining all that.
Yeah.
So what happens if, you buy the policy and then at some point you end up wanting to cancel it or maybe exchange it for something different?
Yeah. So before I touch on that, you also have a free look period when you receive the policy, because usually this is a big financial commitment. And like anything, you never want to have buyer's remorse. So you go through this long process. And sometimes if you're young and healthy, and based on age and based on the amount, they might have what they call a simplified underwriting process. So you could probably get coverage in 30 days. But the older you get, the larger the amount of insurance, you can imagine the extent of the underwriting, when I call it the investigation. Yep. When they're trying to find out about you, it goes longer. But now they tell you, hey, we got an offer, your policy is going to get issued.
Okay.
You still have a chance if for some reason you feel like you change your mind. They usually give you like a 10-day free look period where it's like, hey, you know what? I don't want the coverage. And even in that example where you provided, 2 months premium to buy the coverage, if you decide, hey, I don't want the policy, I get my 2 months premium totally refunded. So you do have a 10-day free look. But canceling the policy really is not hard. With a term insurance policy, you could just stop paying premium and it'll be done. Make sure if they have it set up on auto draft, you want to stop the auto draft because they're going to keep drafting. And a lot of people set up auto drafts because they don't want to forget about making the premium payment. So term insurance is pretty quick. You can stop making payments, especially if you're making cash payments, and they're just gonna, they're gonna keep sending you notices, and it's done. The easiest thing for you to do, though, just so you're not annoyed with those kind of letters in the mail, is just call the insurance company and, hey, I want to terminate the policy. They'll send a form and you're done. Permanent policy is a little different because usually there's cash value involved. Mm-hmm. So if you don't want the policy, you do want your cash value back because that belongs to you. So one little note, unless you put on a rider, when you have cash-based insurance, the amount of risk, the true amount of insurance, is really the difference between the death benefit and the cash value. Because you could put a rider to say, hey, I want my cash value and my death benefit upon my death. But most of the time, it's not worth the rider. The reason why you're buying it is for the coverage. Yep. And so what happens is say you have a $500,000 policy and you have $100,000 in cash value. Really, the true amount of risk is the $400,000. That's the true amount. Because you can technically cancel the policy and get your $100,000. So in that situation, you do want to send in a form, say I'm terminating the policy, I want to cancel the policy, and they'll calculate the cash value they're going to receive. Keep in mind, the procurement of life insurance is like a real estate transaction. There's commissions up front. There are only a few companies out there that do what they call advisory type of policies, but all the major work in placing the life insurance policy is all up front. Okay. So there is a commission that the advisor makes, and usually the clearing firm that sponsors the advisor gets their percentage of. So typically you have a thing called a surrender period. Usually it's between 6 to 10 years depending on the company. So let's say it's worst case is 10 years. So every year it goes from 10%, 9%, 8%, all the way down to 0. So if you decide after the first year to surrender the policy, they will take 10% of the cash value and keep it. So you do have during the first 10-year period some financial risk in regards to the surrender period and the surrender charge. They call it a CDC. Once you're out of the surrender charge period, whatever cash value you have, you would receive back, and then you don't have the policy anymore.
Okay.
Now, the one thing I do want to point out, a cool planning trick, and really where I think it puts permanent insurance in a more favorable light. So permanent insurance used to be used a lot when the unified credit, which is your gift and estate tax credit, is used for people that have very high net worth. Well, and I'm using approximate numbers, but when Trump took office, it was really approximately almost $5.5 million per person. So if a married couple, if your net worth was under roughly 11 million, you would not pay any estate tax. Okay. Now that's jumped up to almost 27 million now because of the tax law changes. So at that time, though, a lot more people were subject to the estate tax, and they would be buying permanent insurance to deal with estate taxes.
Oh.
Yeah, so it was very common. Now I think that's going to come into vogue, but permanent insurance placement after the escalation of the unified credit went down a lot. Well, now they have a type of, I'm going to switch gears here, but long-term care has become a big risk to what I call middle market America. Reason is long-term care, what I call care facilities, whether it's long-term care, assisted living, or even living at home, and you need care options, it's become very expensive. And people are worried about running out of money or not leaving a legacy or living retirement on their terms. So people are buying long-term care policies. Well, that industry has gone through a big change, and what has happened is they have formed what they call a hybrid policy. It's life insurance with long-term care. The emphasis is on the long-term care. The life insurance really is more of a refund of premium, so that because a big complaint with long-term care policies were, hey, you pay all this premium and it's expensive, and you die, I don't get anything back. So now a lot of these policies say, well, let's put an element of life insurance in there so that if you do die and never use any benefits, you get your premium back at least.
Great.
Right? So there's a planning technique here, and you can do this with life insurance policies. As long as you exchange cash value policies for another policy, you can do what they call a 1035 exchange, where you don't pay any tax. Because remember, we really didn't touch on this a lot. You do not pay any taxes on the cash value buildup of your policy.
Okay.
So, and we'll talk about some advanced planning towards the end. But in this case, if say you buy a permanent life insurance policy and it was the right one for you 20 years ago, now things have changed and you want another type of permanent policy or maybe even a bigger one, you could take that original policy and transfer it into the other one with a tax-free exchange.
Okay.
Now, for people that are looking for long-term care, and you mentioned the word earlier, you have basically a forced savings account. Well, long-term care is expensive. So now all these years you're building up this cash valued permanent policy, and you say, well, what do I want to do with the cash value? Now remember, you haven't paid a dime of income tax on it. A planning technique is for people that are what I call in the middle markets, middle America. Those are the ones that are usually more risk, because if you're considered ultra wealthy, you probably don't need long-term care insurance. You can self-insure. But for those that can't self-insure and feel that they're financially at risk, they can transfer that policy, that pure life insurance policy, into the hybrid, what they call a hybrid life policy with long-term care, and not pay any tax. So in the beginning, you were looking, hey, I wanted some permanent coverage, and I was willing to make the higher premium payments because I wanted control down the road of being able to do something with it. Mm-hmm. Well, if long-term care becomes a risk to you, and you look at this hybrid, you can actually transfer that cash in, and it actually helps really lower significantly the possible premium you're going to have to pay for your long-term care.
There's so much more flexibility in this than I ever thought was possible.
Yeah.
So thanks for explaining all this to us. We've touched on this multiple times, but can we talk about the death benefit and, any kind of tax consequences on the death benefit?
Yeah, thanks to legislation, but one of the huge benefits of life insurance is that when you pass away, all your benefits are tax-free.
Great.
So that is huge. And again, it's a real big benefit when someone's in need and they receive $500,000 in coverage, that benefit is tax-free to them. And so typically when someone passes away, there's a death claim form that you need to file with the insurance company. Okay. You need to provide proof of death. But if it happens in the contestability period, based on what the certificate says, the insurance company has a right to investigate.
Okay.
So even if there wasn't any suicide and it was a simple accident, a lot of insurance companies will take advantage of the fact that it's in the incontestability period, and you probably will be questioned about the insured who passed away. But if you're outside of the contestability period, typically you need to provide a death certificate, fill out the form, they'll process it. I would say it's a 30 to 45 day to receive your death claim.
Wow, okay. So it seems like a pretty easy process.
Yes, for most of the time I would say that, yeah.
So the last point would be a lot of my clients ask about the financial wellness of an insurance company.
Yes.
Are there ways that you as a financial professional can give the client the best advice possible?
So just like in investing in the stock market, you want to invest in good companies because you want them to be around. Mm-hmm. It does not do you as the insured a lot of good to buy an insurance plan from an insurance company that is not going to be around 20, 30, 40 years. Now, again, Danielle, we sit here, we don't have a crystal ball. And there have been some cases where insurance companies have gone under. And so what happens in that case, and the insurance company, remember now, it's a trust business, right? I'm buying an insurance policy from you. I'm counting on you to be around. So it's a trust business. And if the insurance industry would allow their companies to fail regularly, no one would believe in buying in life insurance. So when it has happened in the past and these insurance companies have failed, and it's very infrequent, but the big one that I remember when I started in the business back in the 90s was a company called The Equitable. What happened is other insurance companies came in, bought basically what they call the book of business, all the insurers. Now, the benefits changed and for some people because the contracts were too leveraged. They weren't going to pay the same at the Equitable, but it was better than losing all your life insurance.
Exactly.
So to help create peace of mind, which is the only thing you can look for here, you can look at a couple rating agencies. One is AM Best, the S&P, Moody's, and Fitch. These are companies that rate insurance companies based on their financial stability.
Great.
So they give ratings. It's kind of like on the bond market, right? They give, AAA, AA, based on the quality, the ability to pay back debt. When you think about it, and especially when you think about permanent insurance, and the reason why permanent insurance is more expensive, insurance companies know with term insurance, most people let their term policies lapse. So even though they're liable to you and your family during the in this case, 20-year term period, most people don't convert. Most people let the policy lapse. Why? Remember that bubble I talked about earlier. Once you're past the bubble and that high need of risk goes away, your kids are emancipated. Hopefully they're not boomeranging back and coming back to you, right? You paid off your house, you and your husband have made it to retirement. Yeah. The need for life insurance goes down a great deal. And so you might not need the term policy. So the insurance companies know this. That's why term insurance is so cheap, because most of the time insurance companies don't pay. However, with permanent policy, that is a permanent liability on their books. They know if Danielle LeChard pays all her premium payments, she's going to die one day. She's not going to live forever. They're going to have to pay. And so when you know that, you're a liability on their books. So what these rating agencies look at is how strong is the financial well-being, the ability to pay claims for these insurance companies. So you do want to buy from companies that have a strong rating. And part of that goes back to underwriting. There are companies out there, and you have to, again, this is kind of getting in the weeds a little bit, but some companies are looking to buy business. Like, I need more insureds. Well, they might be looser on their underwriting. Well, think about it. Companies that have tougher underwriting usually are more predictable in their outcomes and claims. If I have terrible underwriting, that means I could have all these bad risks on the books, and that company is going to be more financially harmful. Yeah. So usually, as the insured, you obviously want to get your cheapest price. No one wants to pay more than they have to. But at the end of the day, one of the things you do have to factor in is the credit worthiness and the financial stability, of the insured. So those rating agencies, and the really good companies know it, the ones that are best rated, they will come out and the advisor say, well, this company has a AAA rating, it's best rated in the industry. They want to pound that in because they want you to feel safe, and it's good. But I'm not saying here as an advisor you have to have the highest credit rating all the time. Yep. But it is a factor in the decision making process.
Well, we've covered a lot. Is there any other points that we wanted to touch on regarding insurance?
Yes, and again, just to make sure people are aware of it, we don't have time to get into the business applications, but life insurance is used in what they call buy-sell agreements with companies and key man. A lot of people will look at life insurance, and this is a slippery slope. As well, this is people come out and say it's a savings vehicle. As an advisor, I don't say that, and the reason is, remember that hockey stick analogy I gave you, right? And I'm going to give you another analogy. When you save for retirement, you're going to stop working at some day, right, Danielle? You're not going to work until you're right. Hopefully, right? So what's going to happen at some point, you're going to stop working, and you're hoping your savings are going to be able to continue to pay you income while you're retired, right? Now think about this with life insurance. Most people don't want to pay life insurance premiums until age 90 or 85. They at some point want to stop paying premium.
Correct.
Well, that cash value, remember, in early years, you're overpaying for the plan. That money's going into the cash account, and that cash account's growing in a tax-advantaged manner. At some point, the insurance premiums are going up in that plan. Inside the plan, you're not seeing it, but I'm telling you, the insurance company's taking a bigger deduction out of the contract. If you do not have enough cash value in that policy when you stop making premium payments or suspend premium payments, one day, what you'll get is a letter from the insurance company saying, Danielle, you have insurance with us. Guess what? Your cash value is fast approaching zero. And if you do not decide to make premium payments again, so they're going to reappear magically, your policy is going to lapse. Now, here's the problem. You're older. You don't want to pay any more premium payments. You want the insurance, but guess what? Now you're 70 years old, and that $500,000 policy that you bought is going to be super, super expensive. And so having enough cash value is very, very important. And again, it's beyond the scope of the podcast. There are ways in a business setting, and you could do it personally, where if you're willing to pay significantly more into the cash value, above and beyond the premium, you could have what I call a surplus of money that can be used for retirement and taken out in a preferenced manner.
Wow.
But you have to be very, very careful because, like I said, if as soon as you start to invade the cash value so much that the cash value won't support future premium costs coming out for the increased insurance costs, the policy could fail you. And the last thing you want when you're 85 years old is dying the day after your policy ran out.
Yep.
And so that's why I didn't want to dive into it too much, but you have to be very careful when people say, hey, you can help save for your college kids through this policy. While in theory that's correct, it could be a very slippery slope. I don't usually like to mix the procurement of life insurance for my financial plan and say, oh, my insurance can be used to solve all other financial issues in my life. That could be kind of risky because you could be putting the actual integrity of the policy at risk. And then, again, outside of that, the one takeaway I would say in favor of utilizing more cash-based policies is the fact that if you feel that long-term care is going to be something that you're going to need down the road, the permanent policy, because of the tax-free buildup inside of the plan, that could be a more effective way of saving. So now you have permanent coverage, you have flexibility, and then all of a sudden I'm 55 years old and I'm sitting there going, okay, I think I don't need as much permanent coverage, but I have this need for long-term care. I can repurpose the cash value from my permanent life insurance policy and then move it in a tax-favored transaction over to a hybrid long-term care. So that's something people lose sight of now when they're looking at permanent policy. Because I will state this 100 times over. When you're 30 years old and you're looking at buying coverage, term insurance looks very attractive because it's so cheap. And when you're looking at permanent insurance, it's vastly more expensive, but you're understanding there's a reason for it. The period that you're insuring is much different than the period you're insuring for a permanent policy.
Understood.
But yeah, that's about it. I think we covered a great deal. Anything else you want to ask me?
I feel like I'm almost a life insurance expert at this point.
Well, great.
And it's very helpful to know. So, if people have questions, they can, go see their financial advisor. But I think you did a really nice job of explaining.
Thanks. And to the callers, if you have any questions, feel free to reach out to us. You can call us at 877-514-9991. You can visit us on our website at returnonlifewealth.com and you can submit a request there. Again, if you know people, you found this podcast beneficial, please pass on the word, get other people to subscribe. We do this every month. We try to find a financial topic that is of interest and try to dive deep into it so that people can feel a little more empowered so that when they have to make these decisions, whether it's life insurance, estate planning, investing, they feel more confident in that decision. Mm-hmm. Otherwise, thank you for joining us. Danielle, thanks for a great interview. You definitely taxed my brain here. But hopefully, most importantly, the subscribers enjoyed a lot. And with that, have a great day and enjoy life. Thank you.
This has been Frank Wealth Insights, the financial and investment podcast from Return on Life Wealth Partners. Your life, your money, your way. Experience financial planning the way it should be, not the way they want it. See how at returnonlifewealth.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This communication expresses the views and opinions of the participants as of the date it was recorded or indicated, and such views are subject to change without notice. This podcast is being made available for educational purposes only and should not be confused for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. This podcast may discuss forward-looking statements that are based on then current beliefs of the participants. Investment advice offered through Planned Financial Services, a registered investment advisor.